Hello and welcome to Rebank. I'm your host, Will Beeson. Kirill Gertman is the founder and CEO of Conduit, a leading B2B cross-border payments platform powered by stablecoins. Conduit leverages stablecoins to allow businesses to move money faster, cheaper, and more transparently than legacy platforms such as SWIFT. In 2024, Conduit grew transaction volume 16x year over year, surpassing $10 billion in total volume as the stablecoin payment space boomed. In May of this year, Conduit announced a $36 million Series A, co-led by Dragonfly and Altos. In this conversation, Kirill and I discuss the true economics of stablecoin versus traditional payments, when stablecoin payments make sense and when they don't, how corporates use stablecoin payments alongside traditional payments in practice, what needs to change for stablecoin payments companies to win more use cases, how the stablecoin issuance market will evolve post-Genius, and much more. Thank you very much for joining us today. Please welcome Kirill Gertman. Kirill Gertman, welcome to Rebank.
Thank you for having me.
You are the founder and CEO of Conduit, a cross-border B2B stablecoin payments company. But I don't know if your company started focused on B2B stablecoin payments. Tell us where this journey began for you.
Yeah, we definitely did not start in payments at all, actually. When we founded the company, so this is back in early 2021, so about, 4.5 years ago now, we started the company with this idea that there's this new technology, right? Blockchain, obviously, right? There's not just crypto, but blockchain itself. There's this new technology that allows people to build new and exciting things. When I say people, obviously mean, startups, but also corporations, banks, etc. And so we had this idea that it's difficult to access, it's difficult to navigate, and there should be like some sort of middle layer on top of it that makes it a little bit easier, right? So like if you imagine, Stripe on top of credit cards, right? Or Plaid on top of open banking, we had this kind of concept. And that's what we launched with originally back in 2021. And the first product that we released then was essentially a suite of tools, APIs and analytics tools for developers to access DeFi protocols. That was actually working quite well for the first maybe 9 or 10 months of our kind of company life in 2021. But then obviously in early 22, I'm sure you and everybody listening will probably remember the crypto market went through some minor kind of speed bumps, with FTX and 3AC and Terra Luna and Genesis and Celsius and BlockFi and it's probably many more. And so that market essentially went away, right? So the product was still working just perfectly fine. We ourselves were never exposed to FTX, nor we ever let our kind of customers, get access to something like UST, Terra Luna. But the demand completely went away, right? And so we had to pivot, and we pivoted a number of times until we found the actual product market fit. This is what we're doing today. Cross-border payments, specifically on stablecoin rails, and particularly, I would say, targeting emerging markets or developing markets, however you want to call that.
When did stablecoin payments for, real economy businesses become a market, become a product that you could build a business on?
I would say probably in 2023, maybe 22, but we weren't quite there yet ourselves. But I would say somewhere in that kind of 22, 23 timeframe. The product that essentially the basis of our entire business today, we released it towards the end of 23. So maybe in October, I would say, of 23 or September. But I would say that the actual market has existed a little bit previously to that, right? And, maybe to expand on this just for a little bit, essentially the way that I see this market evolving is that I would say the first stage of that was not payments. I would say the first step of this evolution was actually the fact that both individuals and businesses, again, in developing markets and emerging markets, so specifically Latin America, Africa, Asia, were using stablecoins as means of savings, essentially hedging, right? So like if you are in Colombia or Kenya or Nigeria or again, many other countries around the world, you have your local fiat that is pretty volatile, right? And oftentimes inflationary. And so, again, whether you're a business or an individual, essentially you're looking for a way to hedge, right, against your local currency volatility, even if you're not thinking in terms of financial terms like hedging, but this is what you want to do, right? You want to save more of your money. And the best way for you to do that is dollars. most of the time you don't have easy or at all actually access to your actual US dollars, right? So you turn to stablecoins. And I would say this was probably already was happening in 21, 22. Essentially, people and businesses were creating like savings accounts for themselves in the form of a stablecoin wallet, right? So USDC, USDT, not for the purpose of trading, not for purpose of speculation, but literally just from holding like Colombian peso or again, Kenyan shilling or Nigerian naira over the course of 6 months or a year, the value of that holding will go down. But if I'm holding USDC, presumably it's going to kind of stay one or close to one to the dollar. And so that's what started happening before payments became a thing. And we needed that. We as a market, I guess, we as an industry, we needed that first stage because what happened next is that, again, both individuals and businesses even more so, they realized, okay, so I have this hedge, right? And that's cool, but it's not super liquid, right? So I can't necessarily use that stablecoin wallet for other needs other than savings, right? And so for individuals, it's a little bit simpler because, again, if you just need to pay rent or you need to buy groceries or whatever you need to pay for your car, essentially what you do is you just off-ramp back, right? So if you on-ramp from Mexican peso or Colombian peso, Brazilian reals, you kind of just go back to your local currency and you spend it. You give it to your landlord, you give it to your car dealer, and you're good to go. If you're a business, it becomes a little bit more complicated because you still do that, but then you also need to pay for your suppliers, pay your vendors somewhere else, then in a different country. And that becomes really cumbersome because this actually makes it even worse than a traditional process. Because what you need to do first, you still need to off-ramp, right? So you need like your local exchange, your Binance or whatever you have. And then, and you pay fees for that. There's usually withdrawal fees, all kinds of things. And then you take that fiat and you go back to your local bank and you send a SWIFT from your local bank, right? Which is painful and slow in itself. But now there's it's even worse because it's a two-step process, right? And so that's where we were able to come in. That was essentially the first product that we released in late 2023, is allowing businesses to do that sort of off-ramp and a payment somewhere else, right? So if you're in Brazil, and again, you're in business in Brazil, and you need to pay your supplier in Hong Kong, or you need to pay AWS or Google Cloud or whatever it is in the US. So that's what we started doing for businesses. And that's why we grew quite quickly from 23, 24, and obviously still today.
All right, so that makes tons of sense. And in ways answers a question of like, what's the maybe wedge, at the risk of using that word, like naively you could think, hey, stablecoin payments are much more efficient than traditional fiat payments. So we're going to build a stablecoin payments platform and then we're going to go sell it to businesses. Talk about a great way to fail as a company, like the process of ultimately replatforming what is an existing stack, which sure, friction filled as maybe it is, nonetheless works. So what I think you're talking about is basically identifying, like, as a result of this traction in terms of stablecoins as basically a sort of cash balance, and I guess in emerging markets, by extension of that, a payment mechanism. You know how people receiving stablecoins and wanting to do other things with them. So that sounds like was the starting point. And how have things developed from there?
So things developed and still are, in fact, developing, right? I think we're still extremely early in this space. I think there's, I usually say, right, there's quite a bit of hype around this these days, as you may have noticed. And I would say that the space overall, stablecoins in general, they're probably overhyped. Like right now in the short term, they're probably underhyped in the long term, right? Because if you just look at TechCrunch or whatever kind of specialized sort of publication you're reading, you may assume that now everything runs on stablecoins, everybody's doing that. Not really, not the case, right? So I guess my point is that it's still very, very much developing. And the reality is, like in the markets where we're in, 9% of the time, we're not displacing like another stablecoin platform or anything like that. We're displacing legacy systems, right? It's like we're displacing local banking rails, Swift rails, things like that. So we're still very, very early on. But what I would say, so if I were to kind of split this into stages, I think the first stage was kind of like I mentioned, essentially accumulation of the asset, right? So you had to have that. Otherwise, doesn't make sense. If you don't have the asset, it doesn't make sense for you to use it in payments, right? So then we moved into payments. And I would say right now, there's two things that are really important that are happening. So number one, I would say within payments, and this is probably going to sound very familiar to anybody who's kind of built a payments platform. What happens is that you tend to start in the gray area. When you start doing a payments company or a payments PSP in general, your challenge is to bootstrap your volume, right? Essentially from zero to as high as possible, because that's how you get better pricing. That's how you get leverage, right? So you need to bootstrap your wallet. And so what happens almost every time, and you can look at examples such as Astropay and Latam and many others around the world, you start in a gray zone. What does that mean? It means gambling, adult, things that the card networks will not process, right? And so essentially start that. That's what happened with stablecoins, right? So essentially stablecoins, I would say early on were like hyper concentrated in those industries that were not serviced by like at all, right? By banks, by cards and gambling. There's definitely a company in the stablecoin space that essentially built itself up primarily in that niche, right? We're shifting away from that, right? So we as Conduit, we never really served that and we still don't. And, what's happening now is that it's becoming a lot more mainstream, right? So you're moving out of this gray zone, out of these industries, and you're moving into much more mainstream industries, right? So like what we're doing, import, export, e-commerce, payroll, those are like normal everyday things that we all do. And like there's a huge expansion of stablecoins into those areas, right? So that's kind of one thing. The other thing that is still actually very, very nascent, but I think will get a lot more traction like this year and next year, is you start seeing the first kind of stablecoin ecosystems emerge. Because what's happening, and this is not, it's very, very small right now, right? It's like very, very low. But what starts to happen is that you have buyers and you have sellers and they both have stablecoins. And so now they can start transacting with each other, completely bypassing the card networks, bypassing the banks, and I'm just going to send you USDC, USDT, whatever it is, between us, right? And again, in reality, this happens quite infrequently. But I would say later this year and early next year, we're going to start seeing a lot more of these. The challenge with those then becomes essentially interoperability, right? Because I have USDC, you have USDT, and somebody else may have PYUSD, PayPal stablecoin, somebody else may have a Euro stablecoin, whatever it is, right? So now you have to like figure out a way to exchange between all of them in a way that's pretty seamless or pretty frictionless. And that's where we're going as Conduit. I think this is where the industry is going towards, like building new ecosystems. And I think there's also going to be a tendency towards more kind of walled garden approaches within that, right? Because again, if you have an ecosystem, just like Visa, just like MasterCard, that's what Stripe is trying to do, right? That's where Stripe is going. They're going to build like a walled ecosystem where they're going to want to have their merchants and their buyers all using their own proprietary coin, USDB, maybe even their own proprietary chain, supposedly they're building, right? And make it completely like a closed loop system. Makes a lot of sense economically, again, internally within that system. But then you start running into challenges. Okay, but I actually have like the PayPal stablecoin. How do I pay my Stripe merchant or whatever? It's like, so those are the challenges I think we're going to be solving probably in early 2026.
Yeah. All right. So I want to come back to that last point, which is, I think, big enough to structure the second half of the conversation around. Can you zoom in on a specific representative example of exactly the sort of payment that you're delivering today? And maybe payment is too precise a term, be it's like customer need and or workflow that you're solving. And maybe just start by describing it and then could go into hopefully pretty deep detail around like all of the component parts, like the end-to-end flow.
Yeah, I think so. In terms of what is that we're actually doing today and how does it work? It is payments, like essentially we're delivering payments, right? There's maybe 2 or 3 different versions of that, but they all kind of aim at the same thing, which is at the end of the day, people, and again, in terms of payments, right? What they want is they want it to be faster, they want it to be cheaper, and they want it to be reliable, right? And that's it. Like at the end of the day, nobody really cares about the rail so much, right? They care about, and that's just normal. Like that's exactly how businesses work. You care about like, what's the value that I'm getting here, right? Is it better than my current methods? Is it better than Wise or Airwallex or my local bank or whatever it is? And as long as the answer is yes, we're kind of winning, right? If the answer is no, then we're not, obviously. So what we're actually doing today, so I'll walk you through 2 examples or maybe 3 examples. So essentially, we still have this kind of situation where, again, we have businesses that hold stablecoin balances, right? So like they'll build up this kind of stablecoin balance, again, primarily for the purpose of hedging. So in that example, maybe let's take a merchant in Colombia, right, for example, and they are buying goods from China. They're importing like physical goods and they're selling them in their retail locations in Latin America, right? Or sometimes they're importing them from the United States, right? What happens is that the invoice that comes to them is denominated in dollars, right? So even if the actual goods are arriving by ship from China, the invoice is not in yuan, right? The invoice is in US dollars. And you need to pay that invoice, net 60, net 90 kind of thing, right? And so you're sitting on essentially a stockpile of Colombian peso, right? And you're thinking in 90 days, that amount of local liquidity is probably not going to be worth the same amount of dollars that it is today. So what I want to do is I want to get a bunch of stable coins, right? Keep that stablecoin balance and then be able to pay that invoice when the time comes. And it's not a one-off thing, it's a cycling sort of thing. And so what happens a lot of the time is that we work with businesses that essentially want to go from their local currency to a stablecoin balance. And we create like wallets for them that they manage, and they can keep those balances in those wallets. And then, essentially off-ramp from that wallet to wherever they need to pay. So, walking through this example in particular, this could be, I think I mentioned Colombia earlier. So this could be a Colombian peso into USDC wallet that we create on top of Fireblocks. We partner with Fireblocks for this, for that merchant. Keep that balance in the wallet. When the invoice comes, they will literally upload the invoice into our system because we need it for compliance purposes. And we say, okay, you need to pay 100,000 HKD, Hong Kong dollars, to your supplier. We're going to do this payout locally within Hong Kong from one of our partners there. So there's no, you see what I mean? There's no SWIFT that's happening. We just do this off ramp where it needs to go. So that's kind of one variation. I would say the second variation is essentially a stablecoin sandwich, where some of our customers are not necessarily interested in keeping that balance. All they want to do, they want to send a payment today, or they want to receive a payment today. And so there's not this element of hedging. There's not this element of maintaining balance. I'm here and I need, again, maybe a different example. I'm in Brazil. I want to send a payment to Europe. Don't care about stablecoins. All I care about is, again, faster, cheaper, more reliable than my current way. So currently, the way they're going to do this is they're going to go to Itaú, whatever, the large bank, one of the large banks in Brazil, send a SWIFT. There's obviously a fixed fee that comes with that. There's effects that happens there. And the money is going to arrive net like T+2, T+3, and maybe T+4. What we're able to do for them is we're able to essentially get it there in minutes. And the way that this works, and I'll walk through the flow of funds, I guess, in this particular case. So the way this works is in Brazil, we're partnered with Brasa, which is a large FX bank in Brazil. So we're actually going to go from Brazilian reals to a Brazilian stablecoin, BBRL, that is issued by the Brazilian bank, exchange that stablecoin for a Euro stablecoin. So maybe Euro C, Euro E, there's probably 4 or 5 of those right now. And then we're going to off-ramp that stablecoin into like actual euros. And we're going to send those euros to the recipient using SEPA Instant. And that exchange between the two stablecoins happens on chain. It's transparent. It's essentially governed by math. I mean, like, it's not like we call, our guy at the FX desk and like, what's the rate? No. Like it's all automated. And so within that system, we're kind of generally speaking, we measure the settlement times in seconds, right? Or minutes. So like 120 seconds, 2 minutes, kind of end to end from the money landing, from us being like able to receive money in Brazil to the money landing in the recipient's bank account in Europe. So that's pretty fast. And this is why a lot of our customers love this, right? Because it's faster. Now, the caveat here is that other players that can do similar things, Wise and others can do similar things. But what happens there is that they're essentially using liquidity that's pooled up in different places. And there's a cost to that, right? So if you're holding a bunch of euros here and you're holding a bunch of AED over there and a bunch of BRL over here, right? In order to do this, you're essentially exposed to FX loss. And so you need to do all kinds of things to mitigate that. And there's a cost to this, right? And both in terms of like actual what you pay for the hedging and then in DFs and all this stuff, also cost in terms of operational. So people, systems, and we don't need any of that. And so our cost basis is actually lower. And so we're able to offer a lower price to the customer as well. So it's right. So that kind of solves, as I mentioned earlier, like, is it faster? Is it cheaper? And is it reliable? Right. And so that's what we do.
All right. So maybe starting with the second example that you gave, at what point does the client know the cost of the payment?
Upfront. Otherwise, we don't win that transaction. I mean, like, if they don't know the cost upfront, we're not going to win. So we tell them right away.
And you're able to price it, including effectively the on-chain FX, like the stablecoin swap, because you have visibility into, I guess, available on-chain liquidity in the various stablecoins?
Essentially, yes. So like whenever a customer of ours is using our system, whether that's like the web, so we have web UI, we have an API, it doesn't really matter. It's all the same. So when they essentially request a quote, they see the exact amounts those amounts are inclusive of our costs. They're also not usually, they're also when applicable, I should say, inclusive of local taxes. So again, in the example of Brazil, there's IOF, or other countries have other kind of taxes and things like that. And so everything is there, and they know the exact amount essentially up front. Obviously, because this is FX, it's not going to hold forever, right? So every quote, depending on the quarter, there's an expiration timer, and so it just will refresh. So and I think in this example, it probably runs for, I think, 170 seconds, something like that, right? So then it'll just automatically refresh and give you a new amount. So you know exactly what you're getting. And yeah, like the reason that we're able to bake everything in is like so obviously again, there's the local components, whether it's taxes or otherwise, we obviously know that ahead of time. There's also the spot. And then the on-chain effects part is, we know that because we control it in a sense. So we do it ourselves, right? So we run kind of our own liquidity pools, and we have a special, if you will, way to do this that's specifically designed for stablecoin transactions. So like we don't do anything else, right? We don't do any kinds of other crypto assets, Bitcoin, ETH, or tokens, nothing like that, right? And we kind of designed the way essentially to be able to do, again, specifically stablecoins, swaps on chain in a way that's very cost efficient for us and for our clients. And it's also very quick. And so that's why we have a lot of confidence in it, because again, it's ours in a sense, right? The stablecoins are not, but like we have visibility in the process because we are running this process. And so that's how we're able to do it.
Yeah. You're funding the liquidity pools, or you're also incentivizing the market to?
It's a mix. Yeah, it's a mix. So we can kind of do both. And they're not fully open, you know what I mean? Because we work with banks, we work with licensed financial institutions. So there is a compliance layer that's essentially on top of that. So, you know what I mean? Like if you think about Uniswap or other examples, it's not quite like that, because in those examples, again, with Uniswap, you can just put money into a pool, right, from any wallet. There's no KYC, there's no KYB, you can withdraw, right? So like it's a little bit different, right? We have to have compliance on top of it. So we have to know the parties that are using this, and we have to verify them. But essentially, yeah, we can do it either ourselves. We can have, our banking partners or some select liquidity providers that are doing this in a controlled way, I guess I can say.
Okay. And then also in that example, as you talked about Brazil to Europe, and I'm not intimately familiar with Brazilian payment systems, but I am aware that there's been a lot of innovation in recent years. And, Europe has, as you mentioned, SEPA, faster payments in the UK, both of which I imagine make on-off ramps like virtually instant, a matter of seconds. To what extent is that flow that you described dependent on local country payment rails?
Oh, very much so, because essentially, and this is why I like this example, right? Obviously, I'm a little bit biased in a sense, but the reason I like this example, as you said, you have, basically instant rails in Europe, right? So SEPA under 100,000 euro, by the way, right? So like under 100K euro, it's instant. Over 100K euro, like it's maybe a few hours, and depending on the cutoff time, I think maybe next day. But in Brazil, you have PIX. That's, I think, what you were alluding to earlier. And PIX is essentially an instant 24/7, 365 days payment rail that is completely domestic, right? So you cannot use PIX for transactions outside of Brazil, but it works really well inside of Brazil. And so you're absolutely right. When you have instant on-ramp and instant off-ramp, right, on both sides, and then you have the stablecoin in between, the stablecoin sandwich, that's where it works really, really well. And it's very fast. In cases where you don't, you run into friction. And the friction is essentially, imagine we're in the US. Well, I think US domestic rails are notoriously known for their slowness, and they're generally behind. Obviously, there's FedNow, there's RTP, but the adoption of those things is somewhat lagging, right? So they're not quite there. And so essentially imagine if you have to send an ACH and that thing lands, maybe 2 days, 3 days, right? So obviously, again, there's FedWire. There are faster things, but just take the worst case example here. Sending or receiving ACH can take 2 to 3 days. That sucks, right? So like that kind of negates a lot of the advantages. If you need to on-ramp or off-ramp and you need to wait 2 days for it to actually convert, that's a pretty bad experience. That's actually also, by the way, why maybe I'm going on a tangent here, excuse me, but like that's also kind of why I'm not a big believer in domestic use cases of stablecoin. Again, in Brazil or countries like that, so Mexico is another example with Pay, right? In countries where you have like actual modern instant domestic rails, UPI in India, it works fine. I mean, like you don't necessarily need the stablecoin. Again, maybe for the purpose of hedging, accessing dollars, that's a different thing. But for payments, doesn't really work. Not that it doesn't work, but just unnecessary, I guess, right? But then the inverse is also true, right? In the US, we have terrible local rails. If I'm sending a stablecoin from here where I am in Boston to like Los Angeles, and then spend 2 days like just on ramping and then receiving, like it also doesn't work, right? So where it does work, it's actually the cross-border bit, and especially in corridors where you have domestic rails that are good. And the interesting thing is that in a lot of these developing markets, emerging markets, again, the domestic rails are newer and they're faster, they're better. So again, UPI in India, PIX in Brazil, Spain, Mexico, and so on. They're great, but they are only domestic, right? So you cannot use them internationally. You cannot receive money, internationally into this payment rail. So that's essentially what we're doing. And that's what's working so well, because we're connecting these different types of rails with essentially a single settlement layer, which is blockchain and stablecoin, right?
I imagine that for most, at least scaled clients of yours, and there may be exceptions, but for most scaled clients of yours, especially where you're coming into an existing business, existing payments function, I imagine they're running parallel payment options, payment systems internally.
Yeah.
What's the general setup? Like, how would, call it like a 50 million turnover, 100 million turnover business be managing it? How would they be starting to integrate cross-border stablecoin payments via a service like yours into their stack?
Yeah. That's a big subject you just opened, but it's true. This is what we're kind of looking at every day, essentially. There are a number of aspects of this that I'll touch on. And so, any sort of medium size or large, especially large businesses, they're going to be using different rails. They're going to be using a mix of banks and PSPs. And especially if they're kind of, they have sort of broad geographic reach, right? They're going to be using a mix of different things. And we work with businesses right now that sort of historically maybe using like JPM or Citi on the banking side. They may be using a couple of PSPs like a WorldPay or whatever, or Payoneer or something like that, so on the PSP side. And essentially they're big enough to have a treasury management team, right? So that they have a team of people that are dedicated to managing these rails, and they essentially make choices based on, again, same factors at the end of the day, right? Speed, cost, and reliability. So number one, our essentially our entry point is to make it as frictionless as possible. And so if there is a business in the US that's using, JP Morgan, something like that today, we're not going to try and displace every single at once. We're going to say a couple of things. So first of all, let's look at your kind of broad reach. Let's look at all the corridors. Let's look at like where you're sending money to and where you're receiving money from. And we're going to tell you, here's like where we're going to be, again, faster, cheaper, more reliable, right, than whatever rail you're currently using. That's number one. Number two, we're not going to try and like make you switch, right? So again, if you're using JPM, that's cool. Send your dollars as a book transfer from your JP account to our JP account as an example here, right? And then we're going to take care of the rest, right? So again, we're going to do that stablecoin sandwich. We're going to convert into USDC, send it to USDC, maybe to Mexico, wherever it needs to go, convert this into Mexican pesos, right? So essentially what we're saying is you don't need to like reinvent the wheel here. We are, but we're going to plug into whatever you're using currently as much as possible. And we will adapt to you. And I don't think that's unique to us, by the way. Right? I think any company that wants to succeed wants to make the experience as frictionless as possible. I think part of like our roadmap is to go even further, plug into ERP systems, right? So if they're using NetSuite or treasury management systems, there's Kyriba, Modern Treasury, etc. There are systems of record that are built for these purposes that these treasury management teams are using, and we want to essentially be integrated into those, right? So again, it makes it even easier for them to just choose from a drop down or whatever options to say, okay, Conduit is giving me better pricing, faster access, whatever, right? So that's one aspect. And by the way, I would say that within that, usually what we find is the more exotic the corridor, the better we are, right? In the sense. So if you're sending money now working with a company, let's say in Japan, that has a business in Africa, and large sort of many type of the businesses, dealing with like things like Nigerian naira, Kenyan shillings is extremely complicated. Even the current banking partners are not sort of like, they don't have a great experience there. So that's kind of where we can come in essentially as a wedge and say, look, we're going to just do this better for you. Again, within you switching to something new, but we're just going to do this better for you. And so that's a big part of it. I think there's maybe another part, which is who's the customer and what happens there, right? Is it another business? Is it a consumer? Is it a retail customer? Are you receiving money from them? Are you sending money to them? So a couple examples here, if you're sending payroll, again, maybe from the US to Argentina, very common kind of example here. You have like remote employees or contractors or whatnot. A lot of the time they want to receive a stablecoin, right? So they want to receive USDC in their wallet. You as a US employer, you don't want to deal with that. So again, same thing here. Like the way that we get paid here in the US is like ACH or FedWire or whatever. I'm going to say, we'll accept that exactly the same way you send payroll today. Change nothing. We're just going to give you a different account, right? So we know that this is where we sweep that account. But that's all, right? So different account number, that's all it takes. But then on the other side of this, we're going to convert into a stablecoin delivered to your employees' wallets and vice versa, right? So if you have buyers, if you're a marketplace, e-commerce marketplace, whatever, you need to collect from Chile, whatever, right? You're like an eBay type thing or Airbnb type thing, right? So like you need people to pay. We're going to say, look, there's a huge amount of adoption in the population of those countries of stablecoins already. So again, we're going to let them give a stablecoin and check out, but then you will receive dollars the same way you receive dollars today, right? So it's going to be a domestic USD transfer. So I guess, sorry for the very long-winded answer, but I think my overall point here is that we try to make things better, but we also try to make as little friction as possible in terms of switching, in terms of moving to that better system.
Yeah. So it sounds like where you're quote unquote winning versus traditional offerings are primarily in more exotic pairs and or certain into and out of certain countries. And also for certain payment types. You mentioned the contractors in Argentina wanting to get paid in stablecoins. What are the other, I don't want to say low-hanging fruit. How do you expand that range of instances where you can win? And what needs to happen for that universe of use cases to really expand?
Yeah. So this is really interesting. And this is obviously something that I spent quite a bit of time thinking about, right? Naturally, as you imagine, my job is to make our business grow, right? And so, yeah, like essentially, I think you're completely correct. And this is, by the way, this is where stablecoins are winning in general, right? I don't think that what you described is unique to Conduit or in any way, right? Essentially, everybody in the space are basically, as you said, winning in similar ways. And so for us here at Conduit, I think kind of to the question of what needs to happen to broaden the use cases. So there are a couple of interesting things that are happening in this space, obviously, right now. Genius Act, in the US, I'm sure there's a lot of commentary on that. I'm probably not going to be the smartest person to talk about this, but I will mention that is one of those things that is changing that landscape. I think the way that it's changing the landscape is maybe a little bit misunderstood in some cases because, well, at least again, in my kind of limited point of view, what I see people expect is that like banks are going to start issuing stablecoins. I don't think that's exactly what's going to happen here. The way that the act is essentially framed is if you're a bank and you're issuing stablecoin, you need to keep your deposits like 100% of the deposit as a reserve, right? So you cannot do your normal fractionalized banking. That's a huge disincentive for you as a bank to do that because you're going to make less money doing that, right? What I do think is going to happen is deposit tokens. So we've seen a couple of announcements. I think JP came out with JPM, whatever that token was. We'll probably find out later. Citi yesterday, I think, had an earnings call and they kind of talked about similar things. So what you're going to have are essentially tokenized deposits. They're a little bit different from stablecoins. And particularly, I think the important point of that is, again, the bank that's issuing those things can fractionalize the deposit, right? So you put $100 from your paycheck into the bank actually takes 90 of that away and lends it to other people, right? That's how they make money, right? And so they can do that with deposit tokens. They cannot do that with stablecoins, or at least, again, in the current version of Genius Act, they cannot do that with stablecoins. I think that will happen. But I think what's going to be interesting is going back to this question of like fraction, essentially, the space is going to start fracturing in a way. Now you have a Citi coin and you have a JP coin and they're probably going to have some sort of consortium, but there's also like a FiUSD from Fiserv. There's also USDB from Stripe. There's going to be an Alibaba stablecoin and there's already PayPal stablecoin. There's going to be many other ones. So it's both interesting and challenging, right? Because on one hand, everybody will end up with some sort of tokenized deposit, whether that's a straight up stablecoin or a deposit token or a tokenized money market fund, as we were talking about earlier before we started recording, right? So there's going to be some tokenized version of this. And so that, on one hand, that will expand the space of possibilities, because now you can pay Amazon in Amazon coin, and you can receive PayPal coin from your uncle that's sending you money, right? So like, this is really interesting and exciting because it expands the space of possibilities to basically everything that we're doing in the financial space, right? So again, whether that's e-commerce, whether that's payroll, whether investments. So that's really cool. But I think I alluded to this earlier. This also creates huge challenges. Because, now maybe you're receiving a PayPal stablecoin, but you need to pay Amazon in an Amazon coin. And meanwhile, your tokenized deposited Citi is a Citi coin, right? So like, now what? And I think what's going to need to happen here is, again, a settlement layer that connects all of them. And so going back to your actual question, I think that's the opportunity for us. Because as opposed to some of the other big players, maybe the Circle, Tether, whatever, they're kind of tied to their own coin in a sense, right? So they're tied to USDC, to USDT. That's their business. And so they're going to have to be obviously focusing on that. But I think there is space here. And by the way, that also includes Stripe and Bridge, right? Because now they have USDB and so on, right? So like everybody's kind of getting very verticalized in that sense. But I think there's also going to be an emerging need for a more horizontal solution, right? So essentially a settlement layer, clearinghouse, if you will, right? If you talk in TradFi terms like ACH, what is that? Automatic clearinghouse. So clearinghouse for all these things, so that you don't have to think about how do I convert my tokenized Citi coin into Amazon coin, so I pay for my, Amazon Prime. And I think that's what's going to expand our business in particular, is the ability to do that at scale across multiple countries, multiple jurisdictions, multiple companies. I think that's what's going to expand our business essentially.
No, I mean, I've thought about this too. Like, I'm with you. It seems like the natural end state is a huge number of different stablecoins, right? Because there's basically at least some economic incentive, or at least perceived economic incentive, to issue your own stablecoin. And there's zero, in a sense, reason not to, right? Like, to the extent that there's economic upside, then everyone theoretically will do it. That ultimately takes us to an end state, which is just horribly suboptimal. Like having a huge number of equivalents to $1, or equivalents to €1. It just does not seem like a good state. Not to mention, each one, despite standardization through things like Genius in the US and Mika in Europe, they all have different risk profiles. You can kind of make an academic argument about banks, given their role in issuing dollars and holding deposits, quote unquote, a Citi dollar, like a deposit with Citi. Is it equivalent to a Silicon Valley Bank dollar, dollar held at SVB? For GSIBs, I think it is. Broadly speaking, there's the political will to backstop GSIBs. There's even proven to be political will to backstop regional banks to prevent losses, at least in the US. So, you can probably argue that every dollar is equal. I think that's certainly, as of today, and even post-Genius, not true with respect to stablecoins. And then even to your future example, or the business line that seems like you may be thinking about, like building a clearinghouse or an exchange for every different version of a USD stablecoin or every different version of a Euro stablecoin. Is everything always one-to-one or not?
Yeah.
And to the extent it's not, you can argue that it's one-to-one as long as the peg is one-to-one, meaning what the mint and redeem price that the issuer will give you is one. Then you can argue everything should always be one-to-one. But to the extent it's not one-to-one, the whole thing breaks down, right? Literally, the whole thing breaks down right away, it seems to me. And these things stop being fungible, which undermines a lot of the value prop. I wonder how you think about that.
Yeah. So there's a lot of interesting things in what you said to unpack, but essentially, I think you kind of nail it. Like, there's a local sort of optimum, for Stripe, for anybody, Amazon, whoever, it actually does make economic sense to issue their own stablecoin. The cost is low. The barrier of entry now is low, right? And so there's a local kind of optimization that you can do. But that also maybe counterintuitively causes like a global misalignment, right? In a way, right? So like, locally, it works really well for Alibaba or Amazon, whatever, but globally, it doesn't work so well. There's an analogy here that's probably imperfect, but so in the US, right, in the early, I think, 1800s, banks would issue their own dollars. Most people don't know this, but like essentially like local banks in like Kentucky versus Massachusetts versus, Florida or whatever, they would actually have their own dollars. They're all dollars, but they're actually issued locally, right? So this is really interesting. And eventually this is how the system of the Fed came about, right? To sort of equalize this. I'm sure there's like historians here that will correct me. Please do. But essentially, right? And there's also, by the way, this is one of the reasons why the Feds are regional, right? So you have a Fed in Chicago, a Fed in St. Louis, Fed in San Francisco, right? Because they would actually collect all the regional banks and sort of equalize them. And then the Feds would kind of equalize between themselves. And one of the things that they needed to do is those kind of local Feds needed to be, I think, like 3 days horse ride between each other so that they would actually, seriously, not.
Oh, so that's where the original ACH settlement times come from.
Yeah, that's exactly right. That's exactly right. So this is a fun little fact, right? But essentially, right, so my point, I guess, more broadly is that we had similar kind of precedents in the past in some ways. And essentially what happened is like a system emerged that's like quasi-government run, quasi-private, that to kind of manage all that. And we'll see what happens in the stablecoin space, but it could be something similar. But at least in the near term, you are right. Like, so the Genius stablecoins versus MiCA compliant stablecoins, they're not exactly the same. The reserves are different between those two, right? And there's more that are going to be coming. So it's challenging. And like, I will tell you that on its face, let's say something like USDC or USDT can be considered one-to-one. But then the reality of it is that, for example, especially in case of USDT, it is not. And so like, yes, the peg is there, but like, go exchange that. Let's see you actually get one actual dollar for one USDT. That's not happening. Like there's the rate there. There's essentially an exchange rate. Tether will charge you 10 bips for minting and burning. So yes, it's one-to-one as long as it sits on chain. But if you actually want to convert this, suddenly it's not. And then because of that, if you're trading like large amounts of USDT, there's always going to be, discrepancies, little ones, right? So like USDT may be like 9999, but not exactly one. And so, no, they're not all equal. And we internally, by the way, we treat USDT as a volatile currency, actually, because of that, right? So like we don't actually do a one-to-one conversion on that versus dollars, right?
You treat USDC differently?
We do. Because there are abilities, like essentially with Circle, there's more flexibility, I guess, in that sense. USDC we treat one-to-one, USDT we don't. But that's exactly to illustrate your point. And so we built a system to handle this. Just like you would do FX on a maybe bigger scale, so FX between euro and dollars, there's also like a little tiny effects in like, maybe the half a bip or whatever, a bip or whatever it is on dollar to USDT and so on, right? And that's, to your point, that's going to persist. Again, Alibaba coin may not be exactly equal to Citi coin and whatever. And so there's going to be a little kind of bips here and there that you have to charge in order to convert. Presumably, this will be negated by the fact that, again, if you're doing like, again, Amazon coin, but you don't need to pay the interchange because it's not credit card, right? So like there's maybe a 2-3% savings. And then, the conversion is like 0.02. Like you're still kind of winning, presumably. But yes, the very short answer, I guess, is yes. It's gonna be tricky to navigate. And people are not used to this, right? Just now, right? They're like, dollar is a dollar. But on the other hand, people are used to paying. They don't see it, but they are paying 3% on card transactions. Somebody's eating that cost. And so we'll see how this settles. Maybe the merchant eats it, and then again, like the price just goes up. This again, same ways with card transactions. Maybe the consumer is going to pay it, but there's going to be discrepancies.
You have direct mint burn relationships with most of the stablecoins that you interact with?
Absolutely. And I think that's really important, right? So you have to go to the source, if you will, right?
Right. So the related point here, and that maybe this is a good topic to ultimately wrap up on, but of having a large number of different stablecoins is that it's tough to see a future in which there are 1,000 or 10,000 different stablecoins and consumers are somehow like making decisions in terms of selecting like when they're using which and converting back and forth. So that to me suggests that stablecoins get, or at least some of these components get abstracted away from the end customer.
Yeah.
Which of course, I guess undermines the brand value of issuing a stablecoin, at least probably. Doesn't necessarily undermine all of the economics, but to the extent the brand value is part of the perceived reason to mint your own stablecoin now. How do you think about that? if everything gets collapsed, and maybe there's even a bigger question, like the stablecoin value chain, talk about vertical integration, someone like Stripe. You can probably make a lot of arguments as to why every successive layer on top of issuance, as you get closer and closer to the end user, can collapse a lot of the value chain and capture more margin, especially in a marketplace in which there are a large number of stablecoins.
Yeah, I think maybe starting from like the brand value, seeing like that, those are like, there's really strong brands, if you want, right, today in stablecoins. So USDC, USDT, right? Obviously, Tether, people are familiar with that. Essentially, these are moats, right? So like this is for Tether, it's a moat. For Circle, it's a moat as well. I think this will erode over time. So and again, my position as being kind of agnostic in a way, right? We kind of will work with any stablecoin issuer that we deem is reliable and trustworthy. So in my point of view, I would say, yeah, that's fine. If I was Circle or Tether, I'd probably think a lot more about that. I'd probably be more worried. But I think to your point, what we're going to see is that, yes, I think I said this before somewhere, and I still believe that's the case. Now, for stablecoins to win, to actually truly get mainstream adoption, which we're not quite there today, right? They need to essentially become invisible. And so then, the brand value goes away and they become rails, right? And so again, I'm perfect, right? As the founder of Conduit, right? I'm perfectly happy about this. This is fine to me because the way I see our job, so to speak, is essentially do that in a sense. Like build that settlement layer which just works regardless whichever stablecoin. All these kind of issues that I was talking about like a few minutes ago with Tether was, we have to deal with that, right? It's like we have to solve this. But the customer, again, at the end of the day, marketing aside, I think the customer cares faster, cheaper, reliable. That's it. That's what we need to provide. I think what's going to happen, to your point, in terms of like all these vertical players, I think there's going to be a period of time where, again, everybody's going to try to do everything. We got Circle is doing issuance. They have a CPN now, which we're a part of, which is like a payment network, right? So Stripe is already a payment network, but now they're doing issuance, right? Everybody's going to do everything. And they will try to compete with each other pretty aggressively, I imagine, in the short term. I imagine in the long term, it'll kind of settle into maybe something that you're seeing with card networks, where, again, they're interchangeable, right? Like Visa, MasterCard, Discover, like again, to the consumer, is there a real difference? Not really. You're getting some mileage points on one, and maybe that's why you have it. And like you're getting some, discount on the other. Maybe that's why you have that one. I think we're going to end up in a similar space where they're essentially interchangeable, and they're probably winning on some sort of like distribution tie-in, right? So like think about Starbucks today. The balances in Starbucks famously, right? Starbucks is a huge fintech. And so maybe they'll tokenize this and that becomes a Starbucks coin. Cool. And you use it because you buy a lot of coffee at Starbucks. But it's not, but it's not necessarily going to offer like tangible, meaningful benefits. And so I think that's, hopefully I'm making sense what I'm saying. But I think we're going to get into a world where, they're essentially, everybody's doing everything. Is essentially commoditized, and then essentially distribution wins, right? So distribution, branding, marketing kind of wins. But under the hood, it's kind of all the same. Again, from my point of view, I want to be the under the hood part, right? I want to be that connectivity layer, the clearinghouse, take everything, exchange it to everything else. How you sell your coin to your consumers is a little bit more of you. That's kind of up to you. My job is to make sure that it's functional, right? So like it can be exchanged, it can go from fiat to that coin to another fiat, whatever, right? So like that's how I see it. But I think it's going to be a lot of going back to branding. Branding will become important again, but branding not like the stablecoin itself, branding of like tying to like Spotify coins, Starbucks, whatever it is, right? Like I think that's going to come back and become more important over time.
Speaking of branding, I think your company name is incredible.
Oh, thank you. Thank you.
I mean, it just kind of interesting, right? Because it seems like it characterized the original vision of the business you built, but now really, really well characterizes, it sounds like, what you're focused on now.
Yeah, no, that's right. It's almost, I don't want to say I'm too smart about this, honestly. It's almost a coincidence. But again, we had this concept from the beginning, right? How do you connect people to like technology that's better, but hard to access, right? So like that's the idea with the name. It still works. Lucky for us, still works today. Similar concept even today, right? So that's what we do.
Amazing. Well, Kirill, thank you so much for your time. This was an incredible conversation.
Thank you so much. Thank you for having me. I really enjoyed it, honestly.
Kirill Gertman, thank you very much for joining us today. Thanks for tuning in to Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.